All right, we've got a feel for the income statement. Let's do a little bit of analysis on it. And so we're going to have three things in mind. First is we have to have GAAP, Generally Accepted Accounting Principles in the United States. It's IFRS internationally, but in the United States it's GAAP. So we're going to always keep that in mind. Secondly, non-cash items are going to be very important in our income statement because cash is king, and we want to separate those. And of course, time and costs are going to always be a problem. So let's take a look at each one of these individually. So the non-cash items, depreciation is the most apparent non-cash item. No firm ever writes a check for depreciation. You'll commonly hear that. Other non-cash items include unaccounted sales, uncollected sales on account. That's my iPhone that I'm still paying on. Unpaid purchases on account and deferred taxes. None of which represent an actual cash flow. So it's very important to realize, and we covered this earlier, that net income does not equal cash flow, and all of our financial decisions will be made on a cash flow basis, not on a net income basis. Beyond that, there's time and costs. So you think of the future as having two parts, the short run and the long run. In the short run, some costs are fixed and others are variable. But in the long run, all costs are variable. So we can get rid of just about every cost or all costs in the long run. So just because we own this building doesn't mean we can't sell it. Just because we have contracts that lock us in for a number of years doesn't mean in the long run we can't get rid of those contracts. So in the long run, everything's variable, but in the short run, a lot of things aren't variable that we're kind of stuck with. In the short run, equipment, commitments are fixed. Production can only be varied really by labor and materials. Very difficult to change things in the short run. So when you think of time and cost, you think of, okay, in the long run we can make adjustments. In the short run, we're kind of tied. We can vary labor. We can say, okay, you're not working today. The other thing is to vary materials. We don't need to buy any more materials. But overall, we're pretty limited in what we can do in the short run. In the long run, of course, we can change anything we want, and a lot of companies have. In addition to that, the costs and purpose are important. So financial accounts do not distinguish between variable costs and fixed costs. Accounting, remember managerial accounting, we talked a lot about variable costs versus fixed costs. Contribution margin was a huge part of managerial accounting. That is not in financial accounting. We're not talking about contribution margin. We don't discern the two. Accounting usually treats as period costs or product costs. So when you think of accounting in the financial statements, we're either going to put the cost in the cost of goods sold, which is a product cost, or we're going to put it into the period, which is selling, general, administrative, and those costs. So it either goes into COGS or it goes into selling. And one of the two places is where all the costs go with regard to financial statements. So when you start thinking about, oh, well, managerial accounting told me that there's all these different things that can go on. That's true. But now we're in financial accounting. We're in corporate finance. We're not in managerial accounting. We're not trying to manage the company. We're trying to manage the external environment. These are financial statements that we're going to drive out to the public, and the public is going to be reviewing them. These are not for internal consumption, although clearly inside is going to see them. They're really generated for tax and external use. And it, of course, gives us internally a view of the company as well. But managerial accounting is where you will worry about variable costs versus fixed costs and so on. The question in financial statements in corporate finance is it going into cost of goods sold or is it going into selling, general, administrative costs? So those are the two differences here. So those are a couple different looks at the income statement. Next, we're going to take a look at taxes.